In our special investor issue today, we will offer a look at two very interesting assets. 1. Undervalued REIT with high growth potential. Today we will present you with an interesting investment opportunity, American Assets Trust, NYSE. #AAT. This is a real estate company that has undeservedly been overshadowed by the larger players in the market. AAT manages a diversified real estate portfolio that includes office buildings, shopping centers, and apartment complexes. The company's specialty is its focus on premium locations with high barriers to entry, primarily in Southern California. Why AAT stock deserves attention? Impressive financial results. Through the first 9 months of 2024, the company has consistently beaten analysts' forecasts on both revenue and FFO, funds from operations, a key metric for REIT valuation. In the third quarter, FFO was 71 cents per share, beating expectations by 11 cents. Improved balance sheet performance. The company is successfully deleveraging. Current leverage is 5.6x versus 6.4x previously. Liquidity is up 40% YoY to $933 million. Importantly, AAT has investment-grade ratings from all 3 leading agencies. Attractive valuation. The stock trades at a P/FFO multiple of 11.15x, with a sector median of 14.51x. This suggests a potential upside of around 30% just by normalizing the valuation. Robust dividend. The dividend payout ratio is just 60.5% of FFO, which provides a high degree of payout protection and leaves room for dividend increases. Key risks. Significant proportion of office real estate in the portfolio, sensitivity to interest rates and inflation, geographic concentration of assets. Why is there faith in the company's prospects? At first glance, a significant proportion of office properties may be worrisome. However, there are several important factors that significantly reduce this risk. Quality of locations. AAT's office assets are located in premium neighborhoods in San Diego, a city that ranks among the top 10 markets for companies in the biotech and life sciences sector. This is where technology and pharmaceutical companies that need quality office space for research and development are actively growing. Diversified tenant base. A significant part of the tenants are stable companies from the defense sector, educational institutions, and representatives of the pharmaceutical industry. These segments have traditionally demonstrated a high demand for office space even during periods of economic instability. Back to office trend. Major employers including Amazon, Dell Technologies, Boeing, and Goldman Sachs have already announced a return to the 5-day office workweek. This sets an important precedent for the market and incentivizes other companies to follow suit. Financials prove resilience. Despite all the concerns about the office segment, the company has been performing impressively, with revenue and FFO consistently beating analysts' expectations. This is the best proof that the risks of the office segment are largely already factored into current quotes. Management flexibility. The company's management is actively working on portfolio optimization and is ready to adapt to changing market needs. If necessary, a part of office space can be reformatted for other types of use. Thus, although the office segment risk does exist, AAT has significant competitive advantages and mechanisms to minimize it. At current price levels, this risk is already more than factored into quotations, creating an attractive entry point for long-term investors. The information presented is the opinion of the authors and does not constitute individual investment advice. You should conduct your own analysis and consult with professional advisors before making final investment decisions. 2. We advise protecting capital from a market crash. During the period of record highs in the S&P 500 and high company valuations, many people think about protecting their portfolio. We suggest breaking down an interesting instrument, the DNP Select Income Fund, which has been providing investors with stable monthly income for more than 35 years. Why it is interesting for rentiers. Monthly payouts of 8.3% per annum, low volatility, protective characteristics during periods of market declines, asset structure. Black medium small square 78% utility stocks, black medium small square 17% bonds, black medium small square 5% infrastructure MLPs. 3 levels of capital protection. 1. Utility sector, stable cash flow, regardless of the economic cycle, regulated business with predictable margins, low correlation to the technology sector. 2. Bond portfolio gives additional stability benefits from lower rates during crises, diversifies equity risks. 3. Regular payouts. Stable history. Since 1987, payouts have persisted through the 2000, 2008 and 2020 crises. Current premium to NAV is only 2.4%. Things to keep in mind. Yields are lower than the S&P 500 in a rising market. A 24.9% leverage amplifies both gains and losses. Total expenses are about 2.88% per year. Part of the payout is a return of capital. Who might be interested? Conservative rentiers, retirement investors, those who want to reduce portfolio volatility, those who want to receive monthly income. In our opinion, the fund can be a good addition to the main portfolio for those who want to receive a stable monthly income and worry less about market drawdowns. The material is informational in nature. When making final investment decisions, rely only on your own analysis and consult with your professional investment advisor.